Okay, and welcome everyone to our April webinar. We've got Mark and Sam here today going through portfolio performance review and outlook. As usual, it should be about 45 minutes to an hour. We will have a short survey at the end of the presentation. So for those of you who have got a couple of moments just to leave your feedback, that would be greatly appreciated for us. We have included a question that you might not have seen before, where we're just asking for your input or feedback. If there's any kind of topics that you'd like us to cover in these webinars, feel free to pop those suggestions in there as well. And any questions that you have got throughout the presentation, just pop it in the chat box over in the corner there, and we can get to that at the end. Okay, so Mark and Sam, whenever you're ready, take it away.
Good morning, everybody. First of all, hope you had a good bank holiday weekend. It's all capping off a great start to the year, and now we're looking forward more into the meat of the year, so to speak, the middle two quarters. As you can see there, I'll be presented alongside Mark, who you will be more than familiar seeing on every single one of these end of quarter webinars. But yeah, just a couple of things just to tick off some housekeeping to begin with. As you can see here on the disclaimers, this presentation is for information purposes only and does not constitute any financial, legal or accounting advice. Kate Berkshire Asset Management is the trading name of Kate Berkshire Limited, and we are a appointed representative of Ascot Wealth Management, who is directly authorised and regulated by the FCA. The investments are not suitable for everyone. That's why it's really important to seek independent financial advice, potentially through Ascot Wealth Management. An annual management charge does apply to these investments, and any tax legislation that is relevant could change in the future. And of course, as you will probably know from investments, is that there's an element of risk involved, and therefore the investments could fall more than other investments, and you may receive back less than you first put in. So what we're going to be covering, as is normal, we'll take a look back over the previous quarter. We'll look at quarter one portfolio performance and the factors that played into that before moving on to next quarter's outlook and strategy. What we'll also do at the same time is that we will, for the first time, we'll take a more in-depth look at a couple of our constituent funds and why we've included them and how they've affected performance so far. And then we will have a look as well at how we are orientated presently and how that is hopefully going to play out over the next few months. So as mentioned, first of all, we'll take a look back at the previous quarter. So the good news is, of course, is that we are up over the month with just over 2% rise across the portfolios on the quarter. Obviously, if that plays out every quarter, we'd be really happy with an 8% rise to portfolios over the year. We will see how we are orientated to help achieve that in a second. As you can see here, the first month in January was very much characterized by a large rally, which was large parts played from hopes of a peak of US interest rates. There's a little bit of a trend that's been going on for the last year, but the market sometimes gets a bit ahead of itself in between US Federal Reserve meetings. And then you can see round about where the US Federal Reserve meeting was around about the peak here. And then we ended up with a bit of a moderation going through February of those expectations. Then as we entered into March, we ended up with a bit of a mixed picture. So we started off a month with very much talking about Silicon Valley Bank and Credit Suisse. And, everyone was starting to worry, is this another 2008? We'll talk about that in a minute, but it certainly doesn't look like that's going to be the case. However, that did result in a bit of a drop in the portfolios over the beginning of March. However, we ended the month on a high, in part due to currency swings working in our favour, and we're very happy with that. That's ended up for the month. So when we look at the top and bottom performers for quarter, apologies, I should say quarter one rather than quarter four, we see that at the beginning of the quarter in January, one of the large players that really benefited from that belief that rates might be peaking off was actually Europe. A little bit of a sentiment dropping off from the Ukraine war, in large part due to the fact that you were seeing that throughout the winter it was going to be a very mild winter on the continent, and that was going to be very helpful with regards to gas flows. Obviously, you can only store so much gas, and it very much appears that Europe gas reserves were going to hold throughout the winter. And that proved to be the case, hence why we ended up with 4 out of the 5 there being European centric. Furthermore, as I said, because of the nature of believing that rates have peaked, in terms of valuation of companies, this tends to help more so smaller companies, and the active European funds we have here, the Allianz, the Baillie Gifford, and the Aberdeen, they're all very growth orientated funds. So therefore, they really helped drive performance throughout that month. Looking over on the bottom performers, we have a couple of alternative plays in here. So we have the Global Clean Energy and the Hypnosis Sun Trust. Mark might want to talk a little bit about that later. We've actually had a good rally at the beginning of this quarter for Hypnosis, which will more reverse those losses there. So that's been fantastic. What's actually quite interesting here, so the iShares Global Clean Energy Fund is the passive and more of a benchmark kind of fund for the sector. However, our active play, which we supplement that with the Pictet Clean Energy, has, as you can see, outperformed the iShares by 14.7%. So very healthy, positive alpha gain for portfolios there, which has worked out very well. And then,
I think, sorry, just only point to add there. Apologies, guys. I'm attending from a remote location with not great internet, so please flag if my connection isn't good. I just, one point to note, as Sam said, the Hypnosis fund's up about 10-11% since the end of this presentation, and also, as we'll come on to, what's been quite pleasing is actually the JPM, the equity, and the clean energy. As much as they're listed there, they're holdings that we now only hold a quarter of what we originally held. So they're actually all things that we've sold out of for other either US equity in the case of the JP Morgan, and other parts of the world for equity India. So we to a degree they're listed there as the worst performing, but they've actually been our lowest holdings of those funds for the last year or two.
Yeah, completely, exactly. I was actually going to say it's like the same thing on the JPM front. Is exactly that. Is so worst performing there, but there's a reason why we hold it, and it's the amounts that we hold of it has come down drastically over the quarter, and I'll explain why in a moment. So, as you know, we will often report about versus the CBAM benchmarks. These are an internal benchmark which we help use to guide our positioning, to help us ask ourselves questions. Why are we holding a certain weighting in a sector versus a benchmark, and making sure that we don't overplay a position. However, today I'd like to introduce to you the AFO benchmarks. So what are these? These are so AFI stands for Advisor Fund Index. These are a set of indices that are designed to act as indicators of the UK funds market, and more specifically what financial advisors use. They're made of 3 portfolios: cautious, balanced, and aggressive. And these portfolios are made up by an independent panel, which is made by a representative group of financial advice firms. I believe there's 14 firms on the panel. Each firm independently selects a portfolio of funds for each index, and then obviously assigns a weighting to it. And then FE Fund Info then aggregates that all together to create an overall list of constituents and weightings means that each portfolio can have between 50 and 100 constituents. Excuse me. So why do we want to start reporting this to you? Three main reasons, really. First of all, is it is completely independent of ourselves. We have zero involvement in the makeup of this benchmark. And we think that's really important when we are communicating with you, that we have no influence on the results. It's also very relevant because this is a benchmark of active plays by kind of our industry peers. So therefore, it has a real relevance to which you can compare how we're doing compared to our peer group. And finally, it's fair. As I said, it kind of ties in with those other 2 points with the independence and the relevance. With the CBAM benchmark, we make it on purpose quite tough on ourselves in order to really ask ourselves questions. Which is very important, of course, within an investment process that we ask ourselves questions to. But we want something external by which we can measure ourselves fairly to you guys. So, hence, we've added in a couple of new lines within these tables here. So what we see here is across the quarter, so that's the second column in. Let me just do this column here and there. You'll see that versus the internal benchmark, 3 out of the 10 portfolios are outperformed. But I think what's really important here is when we look at how we performed versus the wider peer group, you see that actually we outperformed on all 10 portfolios, and actually by quite a margin, somewhere between 0.85% and 1.54% outperformance on the quarter, which is obviously fantastic. And this is something that's played out as well across 6 months as well. But also versus the internal benchmark, we've had really good performance there for the last 6 months. So we've been really, really happy to report that to you. So almost 4.5% versus the external benchmark. So that's actually really quite positive. On the 1 year, not quite as positive. However, unfortunately, we already knew that our Q2 performance last year wasn't perhaps as good as it could have been. But as you see, we've really been coming back hard over the last 6 months, and we think we're positioned well to continue that for at least the next quarter with some of the trades that we've been doing.
And I'd just add that, yeah, more than anything, we're not removing the other benchmark. We're just gonna add 2, so clients have got 2 to benchmark against. So yeah, we're not removing the existing benchmark. This is only an enhancement to our reporting processes.
Yeah, completely accurate. This isn't a case of us moving the goalposts. We'll report both of them alongside, for complete transparency, etc. So then, having a look at how we're positioned at present. So as you can see here, we have still a large portion within China, within the balanced and high weight portfolios. We'll talk about that a little bit more in a moment, because that's a trade that we've had for a long time, and China had a fantastic rally at the beginning of the year, which has kind of tapered off a little bit. I'll explain that a little bit more in a moment. And then, obviously, as is typical, high weighting in North American equities. It's impossible not to have a high portion in North American equities these days, as there's such a large dominant position in how the US market plays out globally. But we also have our active assets at the top there. Sorry, our alternative assets at the top there, which is our hypnosis play, alongside our thematic funds that we hold, which have actually acted as a real counter-cyclical kind of balance this quarter, which has been quite nice. Yeah. So then, if we have a look at the views here, so this is a very noisy table from which to show you. No doubt Mark will have quite a few views here to talk about. As mentioned, that the China overweight, just try to add a line here next to it. we hold up to 7% overweight. That's actually come down quite a bit over the last few months, as what we've seen is quite a lot of money that's coming from external fund managers into China over the quarter, which has helped boost up the valuations, which has worked out to be really nice for ourselves. And then talking more of the negatives, which we've been avoiding, has been the UK quite largely. There's some economic reasons in behind that, but also we're seeing that real interest rates over the longer term aren't looking to be as promising as elsewhere in the world. So, you know, well, obviously we want real interest rates to be greater than inflation, because obviously what you'd be doing in currency terms is actually losing out in real money. So that's why the UK has been a little bit avoided there. But actually, we've on the equity side, we've been bringing the UK, we've been buying it a bit more this quarter, as we've been seeing some real valuation possibilities playing out this quarter. Mark, do you have any other points that you want to add there? I know that's some slide that you often like talking about.
No, I mean, it's, yes, I mean, we're often discussing a lot in client meetings as well. And yeah, the China position, just continued patience. You know, we've got, again, some slides later in the presentation why, you know, we believe it's the right decision to stick with it. You know, Europe, as you saw from the outperformance Q1, it's kind of, you know, a similar story, you know, that they were our two losers last year, but we don't think that they're either a long-term losers. Europe's kind of banked that sort of thought and recovery. China had, but gave it all back in February. You know, but you know, early part of the year we were up sort of 25 plus percent on the China fund, and again, for us to reduce that overweight, you know, again, that's where we're aiming to at least exit our overweight position. We kind of want a 25-30% rally, and you know, given the Chinese market and you know the joys and non-joys of the government there, and sometimes their unpredictable nature, you know, it'd only take some form of stimulation again at some point during this year, I think, sort of to be seeing those. And again, that's the point. We will review that position. We're conscious it does stick out as a large overweight, as Sam said, has been reduced slightly by others buying into the China value trade, but yeah, that still remains our biggest overweight for that reason, that we're remaining patient. We want to bank some upward recovery, and then yeah, that money will, you know, be allocated. I'd be very, very surprised if that position still remains as it is by the end of this year. We've been patient, but I probably don't have a year's patience on it. We've got other options, other ideas. We looked at switching a little bit of that for direct oil exposure. It's worked well for us in the past, but you know, we didn't put that trade through earlier in the month. But no, otherwise, you know, those positions obviously you can see as we are again trying to take positions where we have some conviction. And you know, as ever, the alternative assets is our kind of fixed income position. We won't take too much time talking about those, but you know, those kind of do work their way back into the UK corporate and North American fixed and government positions as well. So that's where they would be positioned if they weren't alternative assets. So that's probably the only other reminders that we always put out on the portfolio position.
So yeah, talking about the trades, here's the trades for the quarter. As Mark said, you know, these can kind of be put into two baskets really. There's been a movement more into government debt, you know, just off of the back of belief that we are approaching peak interest rates. Therefore, we want to do something what's called increased duration, which would mean that as interest rates move down, you're probably in capital values, they will be the greatest beneficiaries. And not just that, we're starting to see recessionary indicators flag up a little bit more throughout the tail end of this quarter. So if there is a movement towards more safe assets, we are positioning ourselves well in advance for that in the future. There's also been a movement, as you will see around here, we've been starting to reduce our currency hedging position on the US dollar and our US equities. Just as the US dollar's been, well, the pound's been gaining versus US dollar, that's been giving us additional return throughout the quarter. And therefore, just as that's been playing along, we've been wanting to take some of the risk off, just in case there is any kind of reverse movement in the future, just realize some of those gains and consolidate it within the portfolio. Kind of, yeah, really, that's the two major baskets. Obviously, if you want to talk more about those, or if anything, more than happy to talk more about that, either within this environment or one-on-one. So the factors that really played in. So Q1's earnings season was actually rather good, really quite resilient. Things are showing returns of corporate earnings so far. That might start to change in the future, but yeah, it's been playing out quite well so far. Already touched on Europe there. And US inflation is on the next slide, which I'll talk about a little bit more in a moment. As inflation is receding, with monetary policy tightening, you know, it looks like we've pretty much, if we haven't reached a peak, we're very close to it. Things differ depending on what economy, whether how quickly or how long things stay this high for. The UK is looking particularly sticky with interest rates, and therefore you might find interest rates come down slower than in other economies. But in the US, it's possibly going to move down quite quickly. Not back down to where we were, you know, 18 months ago, but I wouldn't be surprised if we are talking in 12 months, at least 1 or 2% lower from present. And then, sorry, I've abbreviated here, the Purchasing Manager Index data. So this is basically business managers. They get polled once a month about their optimism at present and on their business activity. So this data has been improving. There hasn't actually been any negative element on that. We're back into positive territory after it hit negative last year. But how long would this be the case for? Uncertain, but at the moment things here are looking good. And then jobs data. This it seems rather strange that we'd be celebrating seems the wrong word, but certainly quite happy that initial jobless claims in the US have finally started increasing. This was a really sticky number that wasn't moving. What does that mean? It means that basically there's a real tightness within the labour market in the US with many more job openings than there have been applicants. What does that mean? It means that people can demand greater wages, you know, in order to secure a job. But what's been happening with all of the interest rate increases is that actually layoffs are starting to increase. So therefore, you're going to get more applicants going for these roles. And that means that, you know, there's going to be less pressure for increasing wages, which will help feed into inflation data, particularly in the US. And then also within our Q1 macro factors, you know, sterling has had a good quarter, but also the dollar has come off a little bit of the quarter, just as it looks like they're going to be decreasing rates a bit quicker. That kind of feeds out into currency versus the rest of the world. So just very quickly, here just talking about US inflation. So on the left-hand side, we have the headline figure. So that's the core inflation, which is the right, plus other factors such as energy prices, etc., things that tend to be quite volatile. And on the right, you have core. So you can see the headline numbers have really started coming down quite quick, including the data point from yesterday, which was inflation on year-on-year basis decreased 1% in just 1 month, which is obviously fantastic that trend is happening. And on a nominal basis, you know, we're going to be heading for kind of like 3.5%, maybe 4% very soon. However, this may start to be towards the end of current decline on US inflation, and it's part of the reason why we think that the market might be a little bit over optimistic about how quick rates might decrease in the US. Looking over at the US, at the core inflation, we see this very stubborn still, around 6.5%. In actual fact, for the month, it actually increased slightly. Just looking at my notes here, it moved up slightly from 5.5% to 5.6% on the year. This is partly due to the wage inflation pressures that I mentioned, but also shelter costs. In the US, rent costs have been going up very steeply for the last couple of years, and it still hasn't abated yet. However, as I mentioned, with the jobless claims data starting to creep up, there will be starting to be less pressure on wage increases. So this will start to move down, but it certainly isn't the eureka for CPI as mentioned over here. There's still a core sticky pressure here, which means that the US Federal Reserve aren't going to move suddenly down to say 2%. You know, it will be more of a gradual process than that. But as I said, there are leading indicators which suggest that things are moving for the market in the correct direction. And then, as I just mentioned here, talking about the currency, it kind of talks a little bit opposite way to what I was saying the market earlier. You know, in January here, we had a month where everyone was getting very optimistic about the rates coming down. Suddenly, we're at peak rates, which turned out not to be the case. And then throughout February, we ended up with a reversal in that before March ended up coming back down the other way again. But that's worked out well for the sterling versus the dollar. We came into the quarter at around about 120.5. So that's $1 equals 1.20 pounds. No, sorry, the other way around. And we ended up finishing the quarter, it's actually here, at around about 123. So around about a 2% gain that we had on our hedged holdings just from currency exposure. Just a preliminary part, we've had another little jump here to start the quarter, which is obviously will feed that very well into the portfolios, that hopefully, if that maintains. Just going to immediately talk back into a couple of funds, just because of I think they're really important with how they influenced the overall performance of the portfolio for the quarter. And a big one being the JPM US Equity Income. As I said, this was the worst performing fund for the quarter. And it just shows how much of an impact actually this had as an active position within the portfolio versus within its own benchmark. So as you can see from the far left here, as the performance of the fund versus the passive fund that we also hold. It's a large difference. It is circa 10%. Excuse me. And you know, obviously, that's going to make a big difference into portfolios. So if we look on the right-hand side here, so this is based on weightings at the end of the quarter. It was actually greater at the beginning, but still we held in the middle portfolios around about a third of our US position was in this active fund. And the difference between those two performances did make a point up to 0.87% difference in the portfolios, which means that actually this fund in oneself, if it was held as passive, would have resulted in every single portfolio being well ahead of our internal benchmark. That's what I meant by, you know, we're being hard on ourselves on purpose to ask ourselves these questions. But there are several reasons why we hold it. One of which is it actually was the complete opposite story in Q4, was actually a massive active contributor to positive performance, just as good quality active positions. So by that I mean that they have very resilient earnings flows. It was a very important factor within Q4 for good performance versus the benchmark. So it's not a it's not a negative story overall. It's just this one quarter. As a matter of fact, that story of quarter four might play out again in quarter two as these recessionary indicators start to build up. Why did that fund have not such a great month? So if we look here at its positions versus benchmark, as mentioned, with the expectation of declining rates, that, as I said, that very much helps growth-orientated companies. The fund is very much underweight for benchmark on those kind of companies. You know, it's got less than half of the amount of IT companies that the S&P 500 holds. However, for the vast majority of last year, that was very much a positive factor to have, and it may still prove to be the case this year. But on the other hand, we have a high amount of financials, which again has proved really, really good in the sense that as interest rates increase, obviously these businesses are able to earn a higher margin on what they take money in at and what they can lend out at. And so therefore that is very much a positive contributor normally. However, due to the issues at Silicon Valley Bank and Credit Suisse, that really had a knock to the sector for the quarter. However, one thing I'll quickly mention, just in terms of spillover, is it has, despite its large amount of weighting to financials, actually holds a very small amount within regional banks, which are the banks that tend to have the greater amount of pressures at present. They're very much concentrating on other areas such as insurance and asset management, as well as investment banking and brokerage, which makes up more than half of the financials weight. And these are areas I would still expect to be very resilient in this current market. And I will talk in a minute, though, later on about what played out at Silicon Valley Bank and Credit Suisse and why it won't have a major impact on their holdings in the longer term. If anything, we would expect a rebound of the holdings within this fund as people become more aware that this isn't a sector issue, it's more of a company-specific issue. And then, Mark, I know you want to talk about the Energy Global Government Fund.
Yeah, conscious of time here as well, so don't want to keep you guys on for sort of too long. So I probably will, all these slides and stuff will get sent round. The second fund we wanted to touch on here was the Energy Global Government Fund. This has been something that we brought into the portfolios in 2013. Again, this sort of arrival of this fund came, from, I would, say, quite honest learnings of last year with, a world of 2013 currency movements being such a dictating factor, and us wanting to at that entire investment model for the next 10-15 years. So this fund we think plays a very good role as a counter fund for our Vanguard US Treasury fund. That's been our traditional fund is great fund. I think costs 7 basis points. But every back from US, is hedged. So we have the hedge position on equity and bonds. So this was part of a research that we went out. We found lots of the market, just not just in their own US bond holdings, just held bonds directly, and thus had no currency hedging. Something that benefited them indirect last year hasn't benefited them till this year. So this was one fund that we found in our investment space that consciously didn't hedge, unlike most of the options that we had, really. So yeah, we went through a sort of 3-4 fund meeting with very young female managers this fund. It's not your treasuries, which was also something we like about the fund. We get exposure to other the market in this, some being Middle East and Asia, which was separate investment strategy. So yeah, I don't want to for a long time. There's other bits in the slides around the fund makeup where it's invested and so, but it could be an excellent tool for us to use as an alternative to the Vanguard US Treasury Fund. What is going to continue to be an important holding in the portfolios. We've talked about bonds lots, and I think the next 3 to 5 years, especially, bonds are going to be a considerable holding in all the portfolios, certainly overweight versus where we have been the last 5 years. So yeah, this just gives us the best of both worlds. If we are starting to worry about currency, or if we just don't want to take a view on currency, it allows us just to diversify, be able to deliver both clients in the portfolio.
Oh, Sam, I think we might have lost you a little bit there.
Sorry, that was my fault. made a mistake of popping myself on mute. Just very wary of time, just trying to skip on through slides. So yeah, just as Mark was saying, just to build off of that, having the very macro kind of funds allows us to lean on their research abilities. Some of these emerging markets, sovereign debts, as you can imagine, it requires a far more active approach to research, really get into the nitty gritty, and they have far greater resources available than we do to be able to select these. So that's why part of the reason why we chose a more macro fund rather than a country specific fund. As you can see here, it kind of explains some of our positioning within the portfolios. Actually, as I mentioned, with the UK, you're looking at very much over the next 10 years a negative real yield versus inflation. Versus other economies, like even worse than Japan, which is certainly something that you wouldn't have expected 10 years ago. But as you can see, a lot of these are very much more emerging markets, so therefore we need to lean more on their research abilities. And then as you see here, there are, you want to very much be at the top left of this graph. Higher rating and earning more yield, and it shows very much that there are possibilities out here. Looking at China and Mexico, very much outliers here, and these are very much active positions within the fund, and that's why we expect this to outperform over the longer term. Very much look forward to that. So looking forward to quarter 2 2023. What do we have coming up? So obviously we've got to look at the quarter 1, the early season. I mean the quarter 1 set of earnings being reported this quarter. And as previously mentioned on the inflation, core CPI is looking sticky. And very touched on monetary policy. Just have a couple of slides in a second, just some data just to back that up, just showing what things are looking at. And as mentioned previously, recessionary factors improving, and the PMI data is improving for how long. And then that's also mentioned on the jobs data. We've got initial unemployment picking up at the moment. The jobs market is really able to absorb that. However, there are reducing vacancies available. So for how long is that possible? And this is going to feed into certainly into central bank interest rate decisions. When looking at inflation across a wide basket of economies, one thing I would like to point out here is that, sorry, it's not the best table to see for clarity, is we see here the US is very much coming down from around about a year ago, 9.1% to, well, it was February 6th, reported yesterday at 5. However, we still see very much here, the UK is still very much at its peak that it's been at since last July, and is very much struggling to come down from that. So therefore, you'd be expecting interest rates, although there's reasons to expect that this figure will start to come down in the future. For example, on energy prices, we'll have a net 3% difference on that figure. It's still going to be very sticky. Interest rates will still be quite high for a little while yet. And then, yeah, as the wider basket as well is starting to move down, not quite to the same level as the US as quickly, but they are moving down that way. And the key outlier here is, of course, China, and which is part of the reason why we stuck it out last year. Is the central bank is very accommodative, very much pro-growth in that aspect, because they can afford to be, because inflation just hasn't been an issue within the Chinese economy. What that has meant, though, is that there has been a little bit of a currency play there. The yuan has been struggling a little bit, but we've been monitoring that, and with the stimulus that was added at the end of last quarter, has resulted in some of the rally that you've seen in 2023. However, we're expecting the steam on that to start to slow down soon, and we're looking at alternatives. One of the ones we're looking at, in fact, is actually Vietnam, as we see far greater ability for growth there in the economy over the more medium term, as it's very much more a more Western-friendly government in place at the moment compared to China. So we look forward to moving that around perhaps this quarter. As just mentioned, looking at forecast for headline inflation, US is already coming down rather quickly. I think on the UK, they've been a little bit optimistic here. However, the illustrations are that inflation is going to come down, but it's going to take a little bit longer to feed through. As we can see here on the right-hand side, the UK is going to be, but the market rather than economists are expecting inflation to be sticky, quite a bit more sticky than Eurozone and the US. Just trying to speed through these wary of time. As you can see here, that's exactly what I mentioned. UK proving to be the highest for a little bit longer, and that's helping currency. That's helping sterling strength, which is helping our hedge positions, as one would expect. But what is that those high interest rates doing? As you'd expect, it's starting to result in lending conditions to tighten, and this is really starting to have an effect. For example, here I've got the European Union, and we can see for the first time really since 2013, net lending was negative last month. And what does that mean for the wider economy? Well, instead of the cash that you receive, that you have in your bank account, using it to spend for services or for goods, you decided instead to repay the debt you already have. So that means that you're not helping the economy move around. So it's very much a headwind indicator, and that's also starting to show within the UK for households and the US for businesses. So we're very much starting to see lending conditions tighten, and that will start to be a drag on economic factors going into the next quarter. What I'll do actually is I'll go back a slide in a second, and shows here the difference between two graphs in earnings growth expectations. As you can see between the two, so for 2023, the US was expected to grow about 3% this year. That's now pretty much flatlined. And the UK has gone from a marginal growth for this year to potentially a 4% decline on company earnings for the year. So these factors are all having an effect. One thing I would point out from this graph, however, is 2024, still haven't adjusted for it being the new year, is having a converse 2024 uplift. So probably nets off overall, but it is still for 2023 a headwind. And then I'll probably finish on this slide. As I said, we're of time. So I want to talk about banking risk and why the Silicon Valley Bank issue and Credit Suisse are not going to be another 2008. First of all, in terms of holdings on the JPM US equity income, they're very much more large banks. They're not regional banks or small domestic banks. And as you can see from the green line here, when there was the large deposit outflow from these banks in March, a large portion of it went into much larger banks. So if anything, it helped their capacities. And this is very much a small bank issue rather than a systematically wide issue. The other things as well, as you can see from the left-hand side, so core tier 1 capital is kind of like a percentage of the bank's balance sheet that has to be held in far more safe securities, so that therefore in the event of withdrawals, you have a good capital base to step back on. We can see here just how much more resilient the banking sector is going back to 2009. Within Europe, you're talking about a near doubling of this ratio, and in the US, somewhat more resilient as well. So there's very much more strength within the banking sector compared to 15 years ago, and this is very much more of a smaller banking story compared to globally systemic banks. Within Credit Suisse, there was a little bit more. This isn't a sudden flash in the pan. They are a bank that's been having issues for a good few years now. And what's been good about this is that regulators were very quick stepping in, very quick with support and help support for the banking system. So they've learned very much from 15 years ago how to prevent this from spilling out into a wider economic issue. It's been, sorry, Mark, you got something to add? Oh, sorry, you just unmuted. So just very quickly rattle off these, and that really is the end. So as mentioned, review China holdings overweight and potential pivot towards Vietnam. We will continue our currency hedging trade strategy, so that's as sterling continues to rally against the dollar, we will take more of that hedging position off. We'll monitor Hypnosis Songs Fund. We have a trade target of 90 pence in place. It's actually at this morning of 88.5, so we're getting close to that trade possibility. At the beginning of the quarter, it was actually sat at 80. So as you can see, that's been a great movement, and we'll reposition that as and when we hit that target. We've been having very active conversations with our active Japanese equity manager, just making them prove their value to our portfolio. If an active manager can't prove the value, then our default position will be to move back to the passive lower cost holding. And as I spoke there quite a bit about the JPM US equity income holding, we'll continue that analysis there. Continue the movements of sovereign fixed income, potential move away from companies to sovereigns if macroeconomic conditions indicators continue to worsen. But that will be very much orientated in the correct way if that does factor, which is good. And then, as always, examine our style sectors and market capital positions, active asset class, alternative asset class allocations. And as we always are, we're always meeting fund managers really actively, getting their views on the market and getting them to demonstrate their value into our portfolios. But yeah, thank you for that. It actually went a little bit longer than I wanted, but I'm more than happy to talk about any of these, either on this call or offline. We live and breathe these numbers, so more than happy to have conversations with anyone. But yeah, other than that, thank you very much.